Good evening. Tonight is Tuesday, March 19. I'm going to talk about Chapter 21 tonight, at least start it. Chapter 21 is like Chapter 16. Well, not quite. Chapter 16, I think, is the most difficult chapter in this course. I would say 21 is the second most difficult. There are the two chapters which, in the past, when I tried to do within one lecture, I had to go way too fast and didn't work so well. I had to skip some parts. So for 16 and 21, I put them over two lectures so that I have more time to explain properly in details. And except that it's not quite 2 full weeks. So I'm going to start 21 this week. I'm going to finish 21 next week. But it's about a class and a half, a class and 3/4. So we should be done maybe 15, 20 minutes early tonight. The next and final quiz is next Tuesday. It's on Chapter 17 only. Same format as before, same rules. So 10 multiple choice, a mix of qualitative and quantitative questions. You're allowed your double-sided formula sheet, which it's way overkill for Chapter 17. But when it comes to the final exam, it's still going to be doubles. You'll have to do the whole course on a single formula sheet. I don't do single-sided sheet because there's no way that I could check 80 sheets to see if you didn't write something in the back. Suggested exercises, again, one of the best ways to study, because this is not so much a course where you need to read, absorb, cram, and then just regurgitate on a test. It's more of a learn by doing, practice, kind of like picking up a sport. Like you get better at golf by how many swings you have. You get better at skating by how many hours you skate. It's the same kind of thing with this course to prepare yourself for the 3rd and 4th year. So it's a lot about, yes, knowing the formula, but more important is to know how to use the formula, know how to apply them in different situations. Also, a very important skill is to read the text of the question, because sometimes maybe there's a not or some word that changes the meaning of something. So you got to be careful to pick up those. So read the questions carefully, and it's just about practice. The more of all the different things you have for practice, you got all the suggested exercises. And by the way, if you don't have the textbook, I do leave a textbook at the library on reserve, so you can go look at the problems at the end of the chapter. And the other thing is you can redo some of the examples in class, obviously, without looking at the answer. But then you have the course notes, which are the full written answer, so that should help you quite a bit with that. Videos have been difficult. TAs, he's in the last term of his 4th year, so he wasn't able to do them last week, but he's going to do them tonight. So that's going to be caught up by tomorrow, hopefully. But probably if you're here, you don't care that much about the YouTube videos. So how am I going to go into Chapter 21? How am I going to split it up? There's lots of topics. It's just like 16, it's a very mathematical heavy type of chapters. There's many concepts, many different types of problems that you need to know how to do. And it's actually one of the rare chapters which is a lot more based on economics than it is on business. So it's a lot of these, global macroeconomics concept, like purchasing power and interest rates and that kind of stuff. And then, why do we care about this? Well, a big part of this course, remember, we started about capital budgeting, where instead of just being given to you, just these are the numbers, and you just do the net present value of it, you're a lot closer to how it would happen to you in the real world. Is you got a story, you got a text, you got to figure out a cash flow forecast, and and then decide whether it's a good project. Well, the reason why we're doing the kind of economics review, if you can call it that, is the important part in here is international capital budgeting. So just like we did capital budgeting before, but all the cash flows were all in Canadian dollars, all the operations were domestic, what we're going to get into is what happens when you're working for a multinational and you need to do that kind of work, but there's, you're a Canadian-based company, you're making an investment in Brazil, or you're a German company, selling products into China and so on. How do you look at what the net present value of a project is based on you got to, put everything on the same footing? So it's about converting the cash flows in your capital budgeting using exchange rate and forward rates. So first we need to, I need to teach you how these work, and then we can get into what I'm going to do next week, which is how to do capital budgeting when you have multiple currencies flying around. So, international financial management, and how many of you here are in international business? A few? I thought maybe a little more. So, this is the biggest issue when you have companies operating globally is currency. And you really have to keep an eye on that, because if a currency turns on you quickly, it can do a lot of damage. In fact, it's one of the things that killed the first business I ever started. I had a record store. I was buying records out of Germany and the UK, and I was selling them out of Canada into Canada and the US. And my cost in was about 10, and my selling price was about 15. So I made $5 margin on a $10 sale. It wasn't too bad. And then the euro came one way. The euro went up and the US dollar went down, so all of a sudden my margin got squeezed from both sides to the point that the business wasn't viable anymore. So if it can break a tiny little business running out of somebody's basement, imagine what it can do to multinational operations that have billions in sales. If you're selling $1 billion and all of a sudden the currency into a foreign country, and all of a sudden their currency drops by 10%, well, that's $100 million out of your company's pocket. That hurts quite a bit. So there's a lot of mechanisms where you need to, that exist out there for companies to be able to manage these risks. Political risk, there's some qualitative knowledge towards the end of the chapter, but all I can tell you about politicians is that just forget even trying to predict them, or forget trusting them or anything, because one politician is in and then there's an election, next thing you know there's another one that is completely different. So you can't base long-term plans on what political people tell you, because they might be gone in 6 months or a week. The last point is important. The financing companies nowadays, and also government, are more and more raising capital, not only in their home markets but in other places. So it's not uncommon, certainly for Canadian companies, to and especially if, say, you're a tech company, to go list in the U.S. on the NASDAQ instead of Canadian Toronto Stock Exchange. There's Chinese companies that have listed in Canada to raise capital here, and so on and so on. Governments also, they don't sell their bonds. Just the best example is we're talking trillions that the U.S. has borrowed from Chinese people. So there's a lot more, and say in the last 5-10 years, it used to be just very big governments and very big corporations that would do this kind of cross-border financing, but you see more and more of that, and smaller businesses. Some vocabulary now. This is in the cross rate. Let me explain that first one. Say you have three currencies. And what I'm going to do today throughout the course is I'm going to use, instead of using the cute little symbols for you got dollar, and I don't even remember what British pound is. You got euro, I think yen, something like this. What I like to use is the three-letter ISO code for the currency. So it usually, in most cases, there's a few exceptions, but in most cases, it's the two ISO code for the two-letter ISO code for the country, followed by a letter that is the name of the currency. So that gives you the three-letter ISO code for the currency. So US is the two-letter ISO code for the United States, and then USD is for the US dollar. You have CAD, Canadian dollar. Another one is GBP for Great Britain pound. So you'll see that I use that when I teach. It's not quite in the textbook, but it's a lot easier to write out. So a cross rate is, say I have an exchange rate from the US dollar to the Canadian dollar, and I have another exchange rate, call that A and B. I have that I can get A Canadian dollars per US dollar and B pounds per Canadian dollar. Then the implied cross rate is as if you had gone straight through by multiplying the one to the other. Here's the reason why. Just going to skip ahead to explain for a second. If you think of how many currencies there are in the world, and these are just the list of major currencies. If you think of how many currencies there are, probably it's got to be close to 100. If you think there's about 200 countries in the world, and not everybody has their own currency, but quite a few do. So if you just had 10 countries, 10 currencies, then how many exchange rate is that? That's 100 different exchange rates, all the different pairs. So the way that the market has worked in the past, and it's quite convenient, is instead of, how often is a Canadian dollar exchange, say, with I don't know, a South African rand? Not very often. So instead of foreign exchange dealers having to quote every single pair, because somebody might want to transfer money between South Africa, and Canada, instead of doing that, what people do is they all quote relative to the US dollar, and then every currency has a quoted rate with the US dollar, and then if you want to know what the exchange rate between any two random pair would be, you just take it via the US dollar or the euro or the yen, one of the three what are called big currencies in the world. So that's what a cross rate is. A euro bond, you can forget about that because the textbook is so old that something has gone into fashion. And it's now now means something completely different. Historically, what happened was banks, especially in Europe, like London, would take deposits in currencies that are not their home currency. So you could, for example, have a Swiss bank account in Canadian dollars, or a Swiss bank account in US dollars, or a Swiss bank account in yen. And those were called euro deposits. And after that, you had the term called euro currency. Eurobond comes from that concept, but in that concept it was, well, it's when a country, say Canada, sells its bonds, say in yen, and they did that for a little bit. But nowadays, what Eurobond is, and it's an issue of current event, is about the European Union having a tighter fiscal union, and then instead of each country, you have German bonds and French bonds and Italian bonds and so on, to have a single bond to kind of spread the risk of that the Europeans are having. So be aware that Eurobond had a different meaning in the past than it does now. EDC is it's a government agency, well, the Crown Corporation, and what they do is they help Canadian export by being a kind of transfer bank between foreign countries. So when you do, say, very complicated projects and you have, you got to make security deposits, and maybe, say, Bombardier is building like a train in a foreign country and they need to put like a security bond or anything like that. There's lots of these international commerce mechanisms that this company handles, and they also have programs, because the best thing for an economy is to grow their exports. And so this company is, this Crown Corporation is about supporting Canadian companies exporting in the world. So they provide all kinds of service. For example, if you have accounts payable from a foreign country, they'll factor it for you. They'll do letters of credits with foreign governments, foreign suppliers, and foreign clients, that kind of thing. So it's a useful organization if you're a Canadian company and you try to export. So foreign bonds issued in a single country in that in the country's currency. I just explained that. Gilts. There's a couple of different countries that have these nicknames for their bonds, and gilts is just the one for the British ones. LIBOR was in the news in the last couple of months. It's, I would say, together with the U.S. federal funds rate, the LIBOR rate's probably the second or maybe even the most important interest rate in the world. Because what you have is there are fixed rate loans and there are variable or floating rate loans. And so when you float a rate, say, I go and I get a loan from my bank. Say in Canada, it's going to be the prime rate plus 3, or the prime rate plus 5, or the prime rate plus 1.5. Well, the prime rate, the Canadian prime rate, is one of these benchmarks that all the other rates above that, all the loans that are riskier, are expressed as a difference to that one. It's similar to what you would call a risk-free rate. And what it does is companies will have floating rate debt that will say you pay LIBOR plus something. Just like in, say, for a small business in Canada, you'd have a prime plus 3 loan. And so there are, it's trillions of dollars of debt that are benchmarked against that rate. And there's a very active derivatives market, options and forwards and so on. And that's what was going on in Britain, because this is also, it's probably older than than any of the U.S. interest rates, because this is back 200-300 years where you had the bankers around London would meet and talk to each other about the rate, and and it has evolved from this kind of arcane process, and it's something where you had banks that were, the way that it works is all the banks that are a member of the British Bankers Association submit what they think they would loan and borrow from other banks at that time. But what happens is it's not an actual market transaction. It's not like you can go to a tape and look and say, oh, they loan money at 2.3%, 2.2%. It's just a lot of these rates are just somebody calls in and say that's the rate. And what happened is within some of those banks, the banks that were furnishing, that were giving the data to the British Bankers Association, because there's this, this huge market, this derivative market, where if you make, very highly leveraged bet, you can make millions of dollars on, forecasting that the rate's going to be 2.3 instead of 2.15. And so what some banks were doing is there was a conflict of interest between their trading desk and the commercial banking part of the business, where the traders would tell the LIBOR, the people that did the LIBOR submission, oh, make the rate a little bit higher this week or today because, I got this bet, and if the rate goes up by 5 basis points, I'm going to make 300 grand. And that shenanigan just went on for years and years without, people kind of knew about it, but it finally came to a scandal, I think it was in the last 6 months or so. So that's what happened with LIBOR. And this is a can of worms that's nowhere near done. Because think of, there's municipalities in the U.S. that have issued bonds that are floating rate LIBOR bonds. And so what if they paid an extra 10, 15 million of interest because some trader in London was trying to rig the system so that he would make an extra couple bucks on his trades? It's that scandal is nowhere near done. Swaps. Swaps is a kind of derivative. By the way, I don't know if I've told you that before. We're not going to cover derivatives in this course, but you might wonder where does the word derivative come from? It means that instead of being a security that has its own value in itself, it derives its value from something else. So it could be, it's linked to the price of gold, it's linked to the stock of IBM, and so on. It doesn't have in itself value, it's just related to something else. And that's why it's called derivative. It derives its value from the underlying asset that the derivative is based on. There's many different types of derivatives. It's a very, exotic and complicated world. And that's why from now on, from time to time, there's banks that blow their brains out on doing something stupid, or companies, they get in, they do these derivatives trades, and all of a sudden, boom, they lose $1 billion. But there's many different types of derivatives. There's options, stock options you're probably familiar with. There's forward contracts. Another kind of subtype of derivatives is what we call swaps. Now, swaps they exist both in the interest market and the currency market, and they have a slightly different meaning in those two markets. A swap in an interest rate is where it's a derivative contract where what you're doing is you're converting a cash flow from a floating rate interest rate to a fixed rate interest rate. So you might have banks like that say that, say you're a bank where you're selling mortgages, and you're selling fixed rate mortgages, and you're selling floating rate mortgages. But floating rate mortgages, well, not right now because the interest rates are on their way up, but in a down market where interest rates are trending downward, a bank issuing floating rate mortgages is quite risky because, they loan you out the money on a mortgage, say $100,000 at 5%, but then if the benchmark like prime or LIBOR ticks down, all of a sudden they're making 4.5%, 4%. And so this is an example of where a bank would enter into a swap contract, and what you do is you're hedging the floating rate by converting it to a fixed rate. So in an interest rate swap, you have two parties. You have a party that has a fixed rate cash flow, and another party that has a floating rate. And what they do is the contract says that you basically exchange the cash flow. It's a little bit more complicated than that, but that's essentially what the idea of an interest rates swap is. A currency swap is where you're swapping cash flows in two different currencies. So it could be, say, that you have a company based in Canada, and then you have a company based in the U.S., And the company in the U.S., every month is making cash in Canada, and they want to bring it back to the U.S. And then the company in Canada, every month they're making cash in the U.S., they want to bring it back to Canada. So what a swap does, obviously I say, it's one company to the other company. In reality, what you have is an intermediary market in between, which is usually a bank that makes a market. So the Canadian company calls up Royal Bank, say, I want a swap contract for US dollars to Canadian dollars. They're not going to call a company in Tennessee and try to arrange that swap directly. That's what the role of the bank, of the financial intermediary is. It's the clients all call that central place, and then the bank itself, then within its own funds and within its own operation, matches one versus the other. And then if they have an imbalance of one versus the other, then they can go onto an organized exchange and then trade with other banks. And that's how the risk of currencies gets passed back and forth. How do the banks make money? They charge a percentage, so not quite the same exchange rate on both, so that they make a tiny bit of margin in between. And that's the core idea of a financial intermediary, like a bank or an investment bank or some other kind of financial institution. Now, the number of exchange, it opens all the time. You see, stock exchange and opening in, Yemen and all kinds of weird places where the economy is barely afloat. Liquidity on an exchange is extremely important. The bigger, the more volume an exchange has, in other words, the more people are a participant into an exchange, the more likely you are when you do want to sell something that there's going to be a buyer for you there. Think of, I'll give you an example of liquidity. It doesn't quite happen in this context, but it illustrates the concept of liquidity quite clearly. If you buy the shares, you're interested in restaurants, you think that restaurants are going to do well. If you buy the shares of McDonald's one day and then you don't want them the next day, you just sell them back. There's people there. The commissions are pretty small. But if you go and you buy a restaurant, say on Rideau, and then the next day you decide, oh, I don't want it anymore. Well, then you got to come see a guy like me. You got to list it. You got to take in buyers. It takes a few months. You got legal fees. You got maybe some taxes and so on. So that's an example of McDonald's is very liquid because you can just get in and out very easily. Whereas owning a specific restaurant on a street corner is not that liquid because it's going to take you many months to move it, and there are going to be high transaction costs. Well, the idea of liquidity in a market is the more people are around, the more participants are around, the easier it is that you're able to trade on a given day at a certain price. What stock exchange do, especially in developing countries, is they allow companies which before would have had to rely on either government assistance or some kind of unregulated, not very efficient private market. Once a country has a stock market, then companies are able to go public and raise capital, either from people in that country or people from coming other places. What happens with that is Brazil's been having issues the last couple of years with, Brazil's hot. People think, Brazil and China, they're going to grow to the moon, and everything is going so well. What happened in Brazil was there was so much people that want to invest in Brazil that when you have a one-sided flow into a currency, that raises the currency. It's the similar reason why the Canadian dollar has been going up so much the past couple of years, because we have lots of oil and gas, lots of natural resources that we're exporting to the world. So either people from other country, they have to change their money into Canadian dollars to buy it here, or we sell it there and then we have to change that money back to Canadian dollars. And so that raises the price, that raises the value of a Canadian dollar. Same idea with what happened with Brazil. So many people want to flow into that country. The flow of capital was so one-sided. Everybody wants to invest in Brazil. Everybody thinks it's a great investment. And so, yeah, it's great for the local companies, especially the ones that don't export, but it does have a lopsided effect on the currency of a country. And Brazil has been, trying to do defensive measures, like I think they tax money when it comes in the country or something like that. So the mechanisms of stock exchange in developing economies is extremely important, but there are some of these imbalances that can come up. And by the way, this is obvious to most people, that the U.S. has by far the most developed capital markets in the world. Not the oldest. I mean, London's been a financial center long before New York even existed. But nowadays, I mean, everybody wants, the United States is like, the NHL of capital markets. Maybe you have a company and you grow it, it goes public on the little stock exchange in your country, but your company has really become a global player, a global success story once you trade on the NASDAQ or the New York Stock Exchange. Now, exchange rates. I mean, this is some pretty obvious stuff. I'm sure most of you know what an exchange rate is. It's expressed as how many of a currency can you get if you give another currency. Usually quoted in terms of dollars. Some currencies are quoted the other way around. And that's a confusing thing in textbook, what you'll see in a second. Now, this is, way too small for you to see properly, but if you look at the slides, with your laptop or your iPad or whatever, you'll be able to see them a bit better. So if you look at, when you look at over here, you can see that you have Canadian dollar, the euro, the Japanese yen, UK pound, and then there's a little star next to it. When there's a star next to it, then instead of being expressed as a US dollar per Canadian, whatever per US dollar, it's the opposite. So that rate here, the latest 11129, is how many Canadian dollars do you get per US dollar? Then the next rate, 1.27, so let me write this on the board. That first rate there, the reason why I like using the ISO 3-letter codes is it makes the math a little bit easier to see and understand. And it makes it more difficult to flip fractions by mistake, which is easy to do. So the first one now would say that you get 1129 Canadian dollar per US dollar, or you can write it this way. The next one, where it says 1.2792, but you have that star there, that doesn't mean 1.2792 euro per US. It's inverted. So it's that's what that star means. So there's and when you look at, obviously this is how, in the old days people would look at exchange rate. Nowadays you just, go on your computer and you go into your online broker thing and you look at it and you'll see the rates. And most of them, when you click on it, it's going to flip from the inverted rate to the basic rate. So put the star on or off. So that's what they mean by some currencies are quoted the other way around. But the way that I usually write my questions, I write them clearly like this, and it's a lot harder to mess it up. So let's look at that first example. You have the first number is how many Canadian dollars you will get per US dollar. The second number is if you flip that fraction. So 0.8986 is if you divided 1 divided by, let me just write it out. So that's how you get the inverse of the rate. And the two numbers are, well, obviously, that's what I just said. That's what I was saying. Careful when you have that star because it's expressing the rate the other way. So you have 2792, but that's how many US it takes to get 1 euro. So if you do the opposite, you'll get that 1 divided by 12792, you get, for $1 US, you'll get 78 euro cents. So you got to be careful when we do these types of problems, especially when you do the problem on the final exam. I can stop saying quiz now because we're done with the material for quizzes. When you do these types of problems, doing it this way instead of, do I have the star? Am I dividing by the number? Am I multiplying by the number? Am I multiplying by 1 over that number? This is something, you could have like a long chain of calculation. You just flip one of them around and it throws your whole answer wrong. So I'll show you a technique where when you use the ISO symbols like this, it's a lot easier to keep track and make sure that you didn't make a mistake. So if you look at this one here, where you're converting francs into US dollars. So you can look at, I got 1.224. Do I multiply? Do I divide? It gets pretty confusing. So here's a very simple way of thinking about it. I have I have 10,000 US dollars, and I'm going to apply an exchange rate to it. And then I can look at and balance my units like you've seen me do before in some other chapters. If I cancel out this USD with this USD, I'm left with an answer in CHF. By the way, this is the symbol for Swiss franc. CH is Confederation Helvetica. I'm not sure of the spelling, but this is an old expression for the area of Switzerland. In French, it's Hellenic. So this the font name actually comes from the ancient name of Switzerland. So in this case, CH is the country code for Switzerland. And if you look, a lot of the Swiss websites like we have CA, they have .ch. So that's their two-letter country code, and then F for franc. So you can see that by canceling this and that, I end up with what I'm expecting. I end up with an answer in francs. Now, what would have happened if I used the wrong rate or if I flipped it upside down? Say instead of, I looked at 10,000 here. Do I multiply by 12214 or do I divide by 12214? And people are always, am I getting Canadian dollars? Am I getting US dollars? What's going on? Here's a very simple way to make sure that you're doing it the right way. If you had written it the other way, I would have gotten an answer in USD squared divided by CHF. And obviously that makes no sense. So that's a way when you do problems to balance your units and make sure that you do it the right way. You just cancel out the ISO, the currency codes, and then you make sure that at the end you get what you were looking for. It doesn't look like much here, but wait till you string 2 or 3 of these things together. It gets confusing pretty fast. The next one, it's just a similar. This is an example of an inverted rate, with the star. Sounds so complicated until you write it out in that notation I showed you. The currency code for rupee is INR, for Indian rupee. And then INR cancels with INR. I'm left with an answer in USD, which makes sense, because that's what I was looking for. So you can see that using this way of looking at currencies, and instead of putting, I don't even know what the funky symbol for Indian rupee is, but you have all these weird symbols, and then when you want to type something, it's not on the keyboard, it's not on the font, whatever. It's so much easier to write things out this way, because you're using only regular letters, and then you can just balance them out, cancel them out, and make sure you get to the unit or the currency that you're expecting to get at the end. So it looks such a simple thing, but you're going to find this this way of calculating currencies very useful, especially in the future if you're working for a multinational and you writing things out. When I was figuring out stuff for my record store in euros and British pounds and US dollars, Canadian, it was so much easier to do it that way than to try to figure out which way it was going. So here's a simple example of you're going to Australia. You're going to have expenses in Australian dollar, but you want to know how much that is in Canadian dollar. So the budget, how much you're going to spend, 150 AUDs Australian dollar per night. You have 5 nights, and so we know that we have an answer in Australian dollars. And then there's another 2,000 Australian dollar for your plane ticket. Oh no, that's for meal stores and souvenirs. And so that means that what you're going to spend in Australian dollars is $27.50, and then you can just convert it to see, now the Australian dollars cancel out, and I know that I got the Canadian dollar and the US dollar tend to track each other pretty well because they're very similar economies. Former British colonies, both of them a big part of the economy based on natural resources. So the Canadian dollar and the Australian dollars tend to be fairly similar in their types of patterns. Like if one goes up, the other one goes up by about the same amount, and so on. So let's look at, I was talking earlier about cross rates, and then when you look at something like this line here, you got Y115, US1, C1, US. It's a little bit, kind of notation overload. So if you look at the little bit simpler way, or a more clear way of looking at this is to write it out this way. So the first rate is 115 Canadian dollar per USD. The second rate is 115 Japanese yen per USD. And the last one is 105 Japanese yen per Canadian dollars. So if you want something in, by the way, what's going on here is this. You got CAD, US, all this A, B, C, Canadian, US, and Japanese yen. So the first rate is when you're going from a Canadian dollar to a US dollar to a Canadian dollar. So that's the rate A. Rate B is you're going from you're receiving Japanese yen out of US dollars, so it's going this way. And rate C is you're going from a Canadian dollar to a Japanese yen. And so those are the direct rates, the exchange rates for each of the pairs. And then if you want to know what is the cross rate, if you take the cross rate of A and B, so you can write the Japanese Canadian rate using this this way. You have 115 yen per US dollar and 1.15 Canadian dollar per US. Now, this would cancel out with that, and if you crank out that rate, you get 100 Japanese yen per Canadian dollar. Now, can somebody tell me what they see that's odd here? Exactly. So what's happening here is you have a market where the cross rate is an imbalance with the direct rates. In other words, you will make more money going from Canadian to US to Japan than you would use going directly to yen. This is what's called an arbitrage opportunity. Now, arbitrage is a pretty wide financial concept. You're going to talk about it a lot more in your third and fourth year classes, but let me just tell you a very quick story that illustrates the concept. You think the price of something should be the same in different places. That kind of makes sense. So there's a family in the UK called the Rothschild, and they're still around. There's still a bank in the UK called Rothschild. We're talking about generational wealth going back hundreds of years. And the way that those guys got rich is there was three brothers. One of them in London, one of them in Paris, and one of them somewhere else. I think it was Italy. And what they would do is they would have messengers that would go back and forth between the different places on horseback and boat, and then they would exchange what the price of gold in the different cities would be. And so if you had gold is selling for 200 in one place, and it's selling for 100 in the say it's selling for 100 in one place, and it's selling for 150 in the other. What happens? Well, you buy it at 100, and you sell it at 150. Now, what happens with arbitrage? Arbitrage means that it's an instant transaction where you booked a riskless profit. So if I had nowadays where I could call and at the same time, I have somebody in New York and somebody in London that say, oh, the gold is $2 more in that place than the other. Okay, we buy, you sell and I buy, boom, at the same time, and together we make a riskless profit. That's what an arbitrage is. It's where you make, there's more complicated arbitrage situations in other setup, but in this case, in the price of gold, one asset, should be is the same in both places. What happens is, well, if the prices between the two places are different, then people are going to buy where it's cheapest, and they're going to sell where it's higher. What happens? When you buy something, when there's marginal new demand coming into a market, the price goes up. And vice versa, when there's an imbalance, when there's new sellers coming into a market, the price goes down. That has the effect of bringing the price of gold to be the same in both places. Because what happens? Somebody spots that inefficiency in the market, and they're like, "Hey, I can buy something for 100, turn around and sell it for 150. What am I going to do? I'm just going to keep doing that all day long, right? Because I just make money. There's no risk. Boom, boom, boom. It's instant." And so what's going to happen? Well, the price in one place is going to go up to 110, and then it's going to go down to 140 at the other place. Oh, I'm still making $30. I'm still going to keep doing that. Oh, so now the price goes up to 120, goes down to 130 in the other place. Hey, I'm still making $10. I'm just going to keep doing that. All of a sudden, the price gets to 125 in one place and down to 125 in the other. Now it's the same in both. I don't have that arbitrage spread anymore. And therefore, market participants stop doing these arbitrage trades. That's what arbitrage is. It's not a concept that's unique to currencies. It's a theoretical tool that's used quite a bit once you get into more advanced finance in third and fourth year, where the argument is, it's called arbitrage-free pricing. The price of something should be such that there is no arbitrage, because if there was, people love free money. They come in and they just do these trades until the market goes back into the equilibrium. It doesn't mean, the arbitrage-free price doesn't mean that it's impossible, that it's outside of that and it never happens. All it means is that whenever that equilibrium is broken, there are very strong financial incentives for people to take actions in that market that bring back that equilibrium into place, because they're just going to keep doing it until the equilibrium comes back in. So in the context of currencies, we have what's called the triangle arbitrage. So you look at this here, and what this says is, if I went from a Canadian dollar, so I start with 100 Canadian dollars, then I convert it to 10,500 yen. Then I take that 10,500 yen, I convert it to 91.3 US dollars, and then I convert it back to Canadian dollars, and I'm left with 105. Well, I started with something worth $100. I put in $100. I do this, instantly. The arbitrage is not a series of trade over a period of time, because then you introduce the risk that the prices are going to change over time. An arbitrage is where you're able to enter simultaneous trades that create a riskless profit. So what's going to happen if something like that, if the rates go out of balance? Well, somebody's going to spot this, and banks have computers that just know all these kinds of rules, and if any time it goes like 1 cent or 1/100th of a cent, they just jump in and they do that kind of arbitrage trading. What happens if I can put in 100 and do the round trip and come back with 105? Pay back my 100, and I have $5 in my pocket, instantly with no risk. Well, somebody is just going to do it. They're just going to do it over and over again. What is that going to do? What it's going to do is put pressure on the exchange rates, that if an exchange rate is out of balance in that triangle, what it's going to do is, if it's too low, you're going to be buying that currency, so you're going to be pushing that rate up. If there's another rate that's too high, you're going to be selling that currency, so you're going to be pushing that rate down. And basically what's going to happen is that trading is going to occur up until the point where if I wrote called it D instead, what? What's going to happen is somebody's just going to keep doing this triangle arbitrage trading until the direct rate is equal to the cross rate. Remember, the cross rate is two rates together, put together to make a single one, and the direct rate is that. So somebody's just going to do that until all the rates balance out, so that when you do this round trip trading, you end up with the same amount of money that you started with. Because if you didn't, they're like, hey, I'm just going to keep around. You know, I love this ride. Every time I go around the circle, I make more money. So how long am I going to stay in that ride? I'm just going to keep staying in that ride until there's no more money to be made. And so the market forces are going to bring back the exchange rate into equilibrium. The direct rate is going to be the same as if you went through an intermediate currency. So let's do an example. And this is where using the currency codes make it a lot easier. So we have US dollars, euros, and British pounds. And what we're going to do is go to the British pound, to the euro, and back to the US dollar. You'll see in a sec, what happens is, don't worry about where you start, because if the way that these rates are in balance right now, if the correct way around the circle is counterclockwise, but it doesn't matter whether you start at US, British, or euros. You know, if you start at euro, you go to US to British, back to euro, you're going to have an arbitrage profit in euros. If you start in pounds, you go to euros to USD, back to pounds, you're going to have your profit in pounds. But it doesn't matter where you start, you're always going to have an arbitrage profit. If you do this and you end up with less money than you started with, then what it means is, if you do it the other way, it's gonna work out. So there's three things that can happen when you look at three rates like that. One, they're in balance, nothing can be done, there's no triangle arbitrage. Two, there's an arbitrage, but then you do it one way and you end up with the more money, then you know that was it. If you do it one way and it ends up with the right answer, you end up with less money. You just do the same thing, but going the other direction, and then you'll have your arbitrage profit that way. So when you look at these rates, you know, how do I multiply? Do I divide by 0.6928? Do I multiply by 0.6928? Blah, 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 blah. Here's a very easy way to do it. I start with 1 USD. I convert it to 0.6928 British pounds for 1 US dollar. And again, I know that I multiplied or divided by the right thing, because I end up with an answer in British pounds, not an answer in US dollar square per British pound, which makes no sense. So now I have, so this is the first part. Then the second part is, now I have British pounds, I want to convert them to euros. So what's the rate? I have 1 British pound is 1.65 euros. Do I multiply? Do I divide by 1.65? Well, here's the easy way. If British pounds is at the top here, and you want to cancel it out with your next step, then you know it's going to be at the bottom. So you have 1 British pound for 1.65 euros. And then the last one, now I'm in euros, I want to get back to US dollars. So I have 1.1257. Do I multiply? Do I divide? Well, I know that euro is going to be at the bottom. so that things cancel out the way that I expect. And so I know that it goes down here. I can see students when I mark the final exam, I can see students that use that technique versus ones that don't. The ones that don't, I would say half of them, they get one of the three parts of the chain wrong, and then the whole answer is flipped upside down. And then, you know, you end up with something that is equal when it shouldn't be, or it's really confusing, you don't know what's going on. But when you write out the chain of transactions this way, and you cancel out the currencies, and you end up with an answer at the end that you expected, then you know that you didn't flip the fractions anywhere along the way. So if you start with if you end up with 1.015 and you started with 1, then every time you do this, you make 1.5 cents. Well, imagine if you have $1 million. What's that? That would be, you make 15,000, and you can just make that every second until, you know, depending on how, you know, big your trades are compared to the market, eventually you're going to influence the market, and the arbitrage spread is going to squeeze to zero. And then the cross rates are going to be in balance with the direct rate. So that's the idea of a triangle arbitrage. And that's the reason why we don't really care, going back to what I said earlier, that's the reason why we don't really care about quoting, you know, every pair of currency in the world, because once you have you basically have three major currencies in the world: the US, the Euro, well, the British Pound, and the Yen. And so all the currencies are just quoted in terms of that one. And then if there are cross rates, you know, locally that get out of whack, then these banks are just going to go in and do this kind of arbitrage trading. And they got computers that, you know, look at it every second or every 10 milliseconds. So these, don't think that you're going to go into the market and spot these things. I mean, when they exist for less than 10 milliseconds. And there's a bank with a much bigger computer than yours that's on it way before you ever know about it. So that's it with triangle arbitrage. But it was an important point to introduce arbitrage, because that's a concept that shows up more and more into theoretical finance into year 3 and 4. I got 7:08 now, so here's a good place to take a break. Okay, it's 7:20. Let's continue. So the next thing I'm going to talk about is the difference between a spot trade and a forward trade, and the different rates that you have, because markets not only have a spot rate, which is what could you exchange the money for today. And by the way, the concept of a spot price, that's not just a currency thing. It happens in all kinds of things. An example would be oil. Right? You have a spot price for oil, which is how much could you buy a barrel of oil for today. And then there are forward prices. So, you know, how much would you enter into an agreement today and have a price for it, but, you know, receive the barrel in August, receive the barrel in September, receive the barrel in December, receive the barrel in 2014. So a spot trade, the spot and forward markets, they apply in not just currencies. I mean, they are in currencies, oil, any kind of agricultural commodity like corn, orange juice, all these kinds of things. And also financial assets. You can have forward trades on interest rates in 6 months and so on. So a spot trade is where it's the exchange rate where you trade the money today. A forward rate is where you agree in the future but you set the price today, but the actual exchange of goods and money is going to happen in the future, but you lock it in today. So that's quite useful for companies that know that, I'm a U.S. corporation and I have a Canadian subsidiary, and I know that, say I don't know, McDonald's is franchise, but yeah, they collect franchise fee. So I know that I'm going to get a certain amount of money in the future. Well, I could take the risk of the exchange rate going up or down, but if instead I want to lock in my price, then what I'll do is just enter into that forward trade, and then I already, when I do my budget, my cash flow forecast and so on, how much am I able to pay my suppliers, how much am I able to pay my employees and so on, I know what the amount that I'm going to receive in the future. Of course, I'm going to pay a little price for that reduction in uncertainty, but it's better to, you might pay, 0.5% to insure yourself against a 10 or 15 point percentage drop. So that's what a forward trade is. Now, what happens is when you look at the, I realize it's a little bit too small for you, but when you look at the different forward rates, here the spot rate is 1.1129. And then in 1 month it's 1125. Then after that 17. Then after that 1094. After that 1040. So what that's saying is in the future, the US dollars will be at 0.9014. So what this is saying is the US dollar is going to lose value relative to the Canadian dollar over time. That's what the forward market is pricing in. So what you say in that case is that the Canadian dollar is at a forward premium, meaning that in the future it's going to be worth more. The opposite, where you have something where it's going down. Oh, they're just using the flip of those two currencies. If you look at the forward price of the US dollars in terms of the Canadian dollar over time, you'll see that it's going to be a higher and higher number. What that means is you need more and more US dollars to get one Canadian dollar. That means that the US dollar is losing strength over time. So the Canadian dollar is at a forward premium to the US dollar, and the opposite is the US dollar is at a forward discount to the Canadian dollar. So where do those discounts come from? Why do exchange rate move over time? And what are the different forward rates telling you about what the market expectations of those two currencies are? First, we need to go back to some economic basics and the concept of purchasing power parity. So we start with absolute purchasing power parity. Price of an item should be the same no matter what currency it's used to purchase it. So that goes back to my example, the Rothschilds and the gold. And if you have a good, a product that's the same in two places, it should be the same price in those two places once you account for the exchange rate. Now, this is one of those, idealized world where in reality it doesn't really happen, but the conditions are transaction costs are zero. So it's not like, you buy gold in one place for $100, but that costs you a $25 commission. And if you sold it somewhere for $150, but that's also a $25 commission. If you have the transaction cost is the same or bigger than what the arbitrage spread is, then you don't have this purchasing power parity because you're not able to arbitrage it to make it into balance. No barriers to trade. It's getting a little bit better between Canada and the U.S., but it used to be that, there was a lot of what you would call shopping tourism, where Canadian people would go to the U.S. for like a day or two, buy some stuff, and come back because things were so much cheaper in the U.S. versus Canada. Nowadays with free trades, the barriers to trade and the taxes when you carry things across the border. Because most people, they would go and, they buy like, a girl goes, they buy a nice dress, they, either they put it on or they put it in their suitcase and don't declare. And so there was barriers before, but people were arbitraging between the Canadian and U.S. market by getting across those barriers to trade. Then the last one is there's no difference in commodity between locations. That might be one of the main reasons why the price of cars, especially of used cars, has not balanced that well between the two countries. Because in the US, their speedometer is in miles per hour. In Canada, it's in kilometers per hour. And so you have two problems there. Well, three, the transaction costs are not zero because you got to bring the car from one place to the other. Two, there are barriers to trade because, for example, you might have some regulation about catalytic converters in Canada, but not in the U.S. Or like the rules for what makes a car legal in one country versus the next might be just different enough so that you can't take a car in the U.S. like an American person can't sell their car to a Canadian person, then say they take the car to Ontario and they're allowed to use it. I think it's pretty close now. But the last one, no difference in the commodity. In other words, this kind of relationship would not exist if the gold in London was somehow different than the gold in Paris. Like gold is gold. It's got like the same chemical formula, whatever. It's the same no matter where you are. But when you have goods which are either you have high transaction costs to move them back and forth. The Rothschild, what they did is instead of moving the gold back and forth, they would just hold inventory in each one of the spots. And so they weren't, as a family, they were getting rich, but one location might be losing money, the other location might be gaining money, but what was happening is the one that was losing money was losing less than the place that was gaining. So as a family, they were building wealth, but they didn't have to, when the price was different in London than Paris, they wouldn't have to take the gold, on a boat, on a horse to Paris and back and forth. They would just hold inventory in the two places. So that's how they got around to transaction costs being zero, because they didn't have to carry it back and forth. There was no barriers to trade back then. They didn't have customs and so on like we have today. And it was no difference. That's why it worked for them. And that's why there is this argument for the price of gold should be the same in all the places. But if you have some of those that are not true, or they're barely true, there's going back to the example of the car. There's a bit of difference between the two commodity. You got a cars with miles per hour, and so Canadian people don't really want to go and buy the car that's $5,000 cheaper in the U.S. because they don't want to have a speedometer in miles. They really want to have a thing in kilometers. Those three reasons there is why you haven't seen, because you would have expected, we have pretty good roads. It's pretty easy to, go buy a car in Vermont or something and bring it into Ontario. But because of these differences, that purchasing power parity is not quite there. Because if you didn't have transaction costs, if there was no barriers to trade, like, there's no rule against importing or exporting a car between the two countries, and if the car in New York was exactly the same as Ontario, then what would have happened is over time, tons of people from Ontario would have gone to New York, because why would I buy a car for $10,000 here when I can, take one day, go to the States, buy it for $5,000, carry it across the border? What happens in that case? Well, the prices of Canadian cars would have gone down, right? Because if I'm somebody that wants to sell a car, instead of selling it for 10, I'm like, well, I'm going to have to sell it for 8 or 7 so that somebody buys it. And then at the same time, Canadians would have bought all the used inventory out of the U.S. and then eventually when there's like 1 or 2, 3 cars left in the whole state, people would have said, well, instead of selling it for 5, I'll sell it for 7. So all of a sudden the prices would have converged together. But because of you don't have those requirements, that's why that difference in price in cars has stayed quite a bit over the years, even though you would have expected things to have balanced out a long time ago. So that's why it says absolute purchasing power parity rarely holds in practice for many goods. So what is the purchasing power parity equation? It's really simple. It's just like converting one currency to the other. Just the price in the foreign currency should be the spot rate times what the price of it is in Canadian dollars. So let's, very simple example. So if you have a car that's 35,000 in, is it a car? Yeah, it's 35,000 in Canada. Then if you have purchasing power parity, then that car should sell for 1.5 million rupees. So that's absolute purchasing power parity. It's just a matter of converting the price of one good to the price of the other good using this spot rate. That's pretty simple. Now, what the opposite of that is that you can do is if you have the price of something that's the same in two different places, and you look at the difference in the price, that gives you an implied exchange rate based on absolute purchasing power parity. So if a kilogram of apple in Canada is worth one price, and now what's very important here, remember, these have to be the same apples. We're not talking about Macintosh apple and Gala apples, or apples and oranges. We're talking about the same amount of the same kind of good on both sides. That gives you an implied exchange rate of 1.074. Now, an interesting application of this. Now, you'll have to look at that in your slides. And I'm sorry, somebody told me at the break that the slides I posted on CU Learn, I put the one from last week by mistake. But you can go to my website, and I'm pretty sure at my website I put the right weeks there. So this was, I gotta try to fit that on the slide. You probably can't see it very well, but this is a very interesting thing that The Economist does every year. The Economist, by the way, is a very famous magazine, financial magazine out of the UK. Excellent. If you ever have free time, I know you don't really as a student, but it's a pretty interesting magazine to read. And what they do is, they try to look at what is one good, what is one product that sells in a lot of different countries that's the same in all those places. And what they came up with is the Big Mac from McDonald's. Right? Because if you buy a Big Mac in Manhattan, or if you buy a Big Mac in South Africa, or if you buy a Big Mac in China, it's the same thing, or at least it should be. So what they do is then they look at the prices, how the prices of Big Macs from all these different places are. The one exception is India. It's on here somewhere. And they have an asterisk because in India, cows are sacred, so you can't, you're not going to sell beef there. And so in India, there is no Big Mac. They have, a sandwich with some other kind of meat, I don't know, chicken or something. So you don't have the same, when it comes to India, you don't have that the good is the same. So you don't have this absolute purchasing power parity. But for all the other countries, You know, whether you're in China or the Czech Republic or Indonesia or Japan, Malaysia, whatever, the Big Mac is all the same. And so from the prices of that, because if you think that, you know, what goes into the cost of how these local places set their price, it's based on, you know, a lot of their input costs. Like a place in Czech Republic is not going to take their lettuce from you know, a farm in Ontario. So based on those prices, they're able to get an implicit rate between the two countries. And so you can get that in the U.S. a Big Mac's $4.07, but in Argentina it's 20 pesos. So converted in dollars, it's 4.84, and if the implied purchasing power is 4.92. So what that means is they adjust per GDP and so on. But what it does is it gives you a way to have some other way of measuring the currency. And that's how you can spot, because sometimes what happens is you have these imbalances, these financial imbalances in the system where, you know, a lot of people are trying to trade Japanese yen, and so, or, you know, things get out of balance, and the exchange rate is not a true exchange rate because there's some kind of force that's lopsiding it to one side. That's a way to look and get an implied rate based on what the price in the Big Mac between the two countries are, and that gives you an estimate of what the exchange rate between those two countries should be. So that's the concept of absolute purchasing power parity. Now, relative purchasing power parity, absolute is about looking at the difference between two rates at a fixed point in time. Right? It should be the same based on the argument before. Relative purchasing power parity talks about not what the difference between two rates should be in absolute term, but what the relative movement should be over time. So if you look at what it says, it provides the information about the change in exchange rates. Not the actual rates themselves, but how they move relative to each other. That's why we say absolute, because it's the two absolute rate at a point in time, versus relative purchasing power parity, because it explains what the move of the two currencies. It doesn't say anything about what the actual exchange rate is. It just says why one of them should go up versus the other or not, and at what rate. And the basic idea is that the exchange rate, the change in exchange rate, depends on a relative inflation between two countries. So if you think of inflation, what inflation is the loss of purchasing power over time. Right? You know, if you bought a car, say, for $1,000 50 years ago, $1,000 is not going to get you a whole car today. Right? It's a car, it'd be hard to find a new car under $20,000. And so inflation is sometimes a very vague concept, but it comes down to this. Over time, if the same amount of money buys you less, so, you know, it buys you 3/4 of a loaf of bread instead of a whole loaf of bread, or it buys you, you know, like you have to pay more for a car than you did before, then that's the loss of purchasing power. And that's what inflation is. Now, can somebody tell me an example of I would say it's called a currency in quotation marks, that has very little loss of purchasing power, if any? Here's a hint. It's called the fifth currency. Gold. Remember I told you there are 4 major currencies in the world: the US dollar, the euro, the British pound, and the yen. A lot of people call gold the fifth currency because it's held as a store of value. Just like I would keep $1,000 in Canadian cash in a bank account, you know, I can keep a $1,000 gold bar under my mattress, or I can, you know, keep it in the bank. What appeals to investors over time, because especially richer people, is if you have say I have $1 million today, but inflation is so crazy that, you know, a year from now, $1 million will only buy you like $100,000 worth of stuff that it did a year ago. That happens in some countries. So how do you protect yourself against that? By keeping some of your money in gold, which doesn't have that loss of purchasing power over time. Here's another question. Can somebody tell me why gold does not have inflation in it? Or if it does, it's very small. It's so small it's almost not measurable. Think of how easy it is for a country to print new money versus how hard it is. You know, that just Ben Bernanke goes on TV and says, I'm buying, you know, I'm doing quantitative easing and I'm buying $85 billion worth of U.S. government bonds every month. What that's doing, it used to be, you know, countries would literally, it's called printing, because countries would literally have in their central bank like a printing thing where they would, you know, run the machine, it would create dollar bills. And so the more dollar bills you had, the more that created inflation. Nowadays, the printing is done, you know, kind of electronically and through monetary policy, like these quantitative easing things and so on. But think of, how do you print gold? You have to go dig a hole in the ground, and then you have to, but when you get it, it doesn't come out as a bar of pure gold. It's in concentration of maybe, you know, 1% to 5% or less. So you got to take out 1 ton of rock to maybe get, you know, a few kilograms of gold. That takes stupid amounts of money. Like, you got these giant, like, gold mining is one of the most challenging industrial endeavor that there is. And so what that does is it puts a brake on new gold coming to the market. Because if all of a sudden there was gold mines everywhere in the world and the amount of gold in the world doubled that existed, like in the next year, we're going to dig out as much gold as we have on top of the earth right now. Well, all of a sudden the price of gold would drop by half. That would be inflation. That's where inflation comes from. But the key point I'm trying to make you understand is that it's so hard to have that inflation in gold, whereas with paper money, especially, you know, going since the 70s, where you don't have that peg to gold anymore, you know, the central banker can just say, I'm creating $1 trillion. There was a history, there was a story about, you know, they were going to print a $1 trillion coin. And then, you know, Barack Obama was just going to walk to the bank and deposit it, and they were just going to print $1 trillion that way. Well, what would I have done? That would have created $1 trillion worth of inflation in the currency. So, wouldn't have been a great idea, but it's one of these, you know, out of the box things. All of this to try to explain to you the concept of purchasing power parity and the relative purchasing power parity of two currencies over time. If you have one currency that's expected to inflate much faster than another one over time, then that currency is going to be at a forward discount. Because what it says is, okay, today I can buy, say, the same amount with 2 Canadian dollars or 1 British pound. If I expect the Bank of Canada to go crazy and print like, you know, like there's no tomorrow and create a bunch of inflation, and then all of a sudden I need 3 Canadian dollars, it would be the other way, so my Canadian dollar's worth less, so I have to pay more to get the same amount in British pounds. So what's happening is, if the inflation is higher in one currency than the other, then the currency that has the higher inflation is losing its value at a faster relative rate than the other one. That's why it's called relative purchasing power parity, because it's about what the relative change between the two currencies is going to be over time, and that's rooted in the difference in inflation between the two places. So, the expected exchange rate is going to be whatever the exchange rate is today, multiplied by the spread between the two inflation rates between the two countries, and then times how many periods you have. So if the Canadian dollar is inflating faster than the foreign currency, then that's going to be a negative amount. And so the forward rate is going to be lower than the spot rate. And vice versa, if you expect the inflation rate in the foreign country to be more than in Canada, then the Canadian dollar is going to be worth more in the future relative to that currency than it is today. That's the key point of relative purchasing power parity. It says the last point, because absolute purchasing power parity doesn't really, it's not something that you can use because there's so few goods where you could actually do the arbitrage to even it out. But relative purchasing parity actually holds quite well because you'll see in a second there's a more complicated form of arbitrage that you can do when these things are not in balance. So here's the example. You have the Japanese spot rate is 130 yen per CAD. Japanese inflation is expected to be 2%, and Canadian inflation is expected to be 6%. So what that means is the Canadian dollar is going to lose its value faster. In a way, it's kind of a race to the bottom, and it's who doesn't lose value over time. Their currency keeps up. So if the Canadian inflation is higher than the Japanese inflation, then what you expect is the Canadian dollar is going to be worth less relative to the yen in the future. So right now it was at 130. And the expected spot rate, that's what ES3 means, the E for expected. You should have learned that in a stats course. S3 for the spot rate in 3 years. And so you can see that if the spread between the inflation rates is 2 and 6, then today you would get 130 yen per Canadian dollar, but 3 years from now you're only going to get 115 yen per Canadian dollar. So what we say in this case is the Canadian dollar is at a forward discount to the Japanese yen. There's another example. So here, the inflation in Britain is 8%, and inflation in Canada is 5%. So here, the Canadian dollar is going to be at a forward premium, and the British pound is going to be at a forward discount. This is a relative thing. You can't talk about forward premium, forward discount if you're not talking about the exchange rate between two currencies. So what's going to be the expected value of the spot rate a year from now? It's going to be the spot rate Now, one thing that I see people flipping around, what I like about marking finals year after year is that I get a pretty good pattern of where people are making mistakes. It's the foreign rate is first, sorry, the foreign inflation rate is first, and the domestic inflation rate is after. So I've seen people, flip that around sometimes. So you get the foreign currency is the first one here, and then the domestic currency is the second. So here you have the current rate is 0.5810. Now, since the British pound has a higher inflation, you expect it to lose value over time. And so you'll be a year from now, you're you're going to need to pay more British pound to receive 1 Canadian dollar. Or vice versa, if today for $1 you receive 58 pence, then a year from now for $1, for 1 Canadian dollar, you'll receive 59 pence. Because the value of that Canadian dollar has lost purchasing power parity slower than the British pound. Here's a twist on relative purchasing power parity. You have a spot rate between a country and Canada, and you have the oh, okay, I see what it is. Here we were looking at the absolute change in the exchange rate, and now we're looking at the percentage change in the exchange rate. So FC, it's just a foreign country that should be not named, especially if that's a country that has a 57% inflation. That means that, you know, 1 year you buy something for $1, the next year that same thing costs you $2, or almost. Sorry, it costs you $1.57. So what that means is the spot rate, which would be in front, would change by, would be multiplied by 1.53%. What that means is that's a plus 53% change between the two currencies. So next we get to the kind of high point. Let's see what the time is. I think it makes more sense to take the break here than after that. Okay. So it's 8 o'clock, 8:02. Let's continue. So now what I'm going to get into is the concept of covered interest arbitrage, and it's what brings together everything I've talked to so far tonight. It brings together the idea of the spot rate, the forward rate, and the interest rates between the different countries. For Canada, the risk-free rate is the T-bill rate, so it's the short-dated government paper. So let's look at this example. You have that the spot rate is 2 British pounds per Canadian dollar, but the forward rate is 1.8. And then the two interest rates in Canada, you can invest money and borrow at 10%, and in Britain you can do it at 5%. Should say RGBP there. So this is not the same as the triangle arbitrage, but like I told you before, the concept of arbitrage is not just a single thing. It's a general kind of methodology and reasoning that applies in many, many different setups. So in this case, before what we were doing with triangle arbitrage is we were looking at the equilibrium of the cross rates and the direct rates. Now what this covered interest arbitrage does is it gives an argument for what the forward rate should be relative to the spot rate. Because in a similar, the arbitrage pricing concept is pretty universal. Because if it's not, then you can do something where you make free money, and everybody loves free money, so they just keep doing it until it's not there anymore. And so this is an argument for why the forward rates and the spot rates should be related to the interest rates in each country. So let me show you what's going on here. So you start with 100 Canadian dollars. So you borrow 100 CAD at, our CAD is 10%. So you have there's two time scales we're looking at right now. So today, you borrow 100 Canadian dollars at 10%. Using that 100 Canadian dollars, you convert it to 200 British pounds. So the exchange rate here is 2 GBP per CAD. So that's your spot rate. The amount that you can convert into one into the other today. Now the rate in UK is 5%. So that means that if you invest $200 at 5%, then a year from now, you will have 210. So 200 times 1.05, you will have 210 British pounds. A year from now. Now, you know that today you can, remember that the concept of an arbitrage is you got to lock in all your trades at the same time. It's not like you can do half of it this year and then a year from now convert back to Canadian, because lots of things can happen in 1 year and the exchange rate could have gone up or down. But the purpose of the forward rate is that today you can lock in what you're going to be able to convert your 210 a year from now. So at the forward rate, which you lock it in today, you know the transaction is going to occur a year from now. So the forward rate is 1.8 British pounds per CAD. So that will mean you will have 116 Canadian dollars. Now remember, you borrowed 100 Canadian dollars, so you'll pay back the loan. So 110 Canadian dollars is going to go back to whoever you borrowed it from, 100 plus the interest rate of 10. And then you have $6.67 of arbitrage profit. Oh, my. I'm going to point it out this way, but that doesn't mean you're going back in time. So what happens? You started with no money, you borrowed money from somebody else, and you just created $6.67 out of thin air by just locking in all these trades today. Because it's not like you do this and then a year from now you hope that the rate is still 1.8 and then you get your money, or maybe if it was less you end up with less and you got to still pay back the 110 but you're making a loss. No, because the forward rate is something that you enter into the contract today, but the actual transaction takes place into the future. You know that you lock in that 1.8. So you've locked in that trade structure where you've put up $0 and you've made $6.67. What's the return on that investment? What's 6 divided by 0? Infinity. That's a pretty good investment. Doesn't get any better than that. So you put up $0, you make 6. That's an infinite, in percentage term, profit, and you're guaranteed to do it. So what happens when these things come up? It's the same as the triangle arbitrage. People are like, hey, I love free money. I'm just going to lock this in. So when people do this, they lock in the structure. So if they borrow more and more in Canadian dollars, that's going to have the effect of raising the interest rate. Right? When there are more borrowers in the market than there are providers of funds, the interest rate goes up. So that's going to bump up the interest rate here. You're going to be converting Canadian dollars to British pound. So if a lot of people are doing that, or it could be just one person doing it in a big chunk, or it could be 10 people doing it in 1/10 chunk, the amount is going to be the same. What happens is you're going to put a downward pressure on that exchange rate. Because if there's lots of people with Canadian dollars, and they all want to buy British pound, but it's not going the other way, then the value of the British pound is going to go up, and the value of the Canadian dollar is going to go down. So what's going to happen is you'll have a smaller number here. You're going to be investing in that currency, so that's going to it's going to reduce that interest rate. So it's not all going the same way. It's a balance between everything. It's like I told you, this course today is more about economics than it is about business. It's a lot about equilibrium of different things. Then the forward rate, the more that you people are buying into one currency versus the other, it's going to create a forward premium or a forward discount. That's how the market, that's how you can read what the market thinks of what the forward rate is. Because if the forward rate is too low, they're going to be buying it. If the forward rate is too high, they're going to be selling it. So if the market thinks that the forward curve is not in line with what the inflation expectations are for that country, then these trades are going to move those forward rates around until they get to the market thinks, it reflects what the market thinks the expectation of inflation is. It was a lot simpler to think of, the price of gold in two places, or the currency, three currencies around a triangle. This is a lot more complicated because you have four variables that are in balance with each other. The spot rate, the forward rate, the exchange rate in one country, and the exchange rate in the other country. Before, it was with the gold that the arbitrage equilibrium was just that the price of gold was the same in two places. That's really easy to understand. Then, with triangle arbitrage, it was that if I went through an intermediate currency to get to the final currency, it should be the same as if I went directly. Otherwise, you have the triangle arbitrage. Here, it's a lot more complicated because you have those four variables. But what it's telling you is that those four variables should be in some kind of equilibrium with each other. So what that's called is interest rate parity. It's a relationship between the ratio of the forward rate to the spot rate should be the same as the ratio of the two interest rates between the two countries. Now remember that nominal interest rates have both an inflation part and a real part in them. So when we talk about whether we use H for inflation or R for the nominal rate, the effect is in both because it's the inflation is captured within the risk-free rate of a country. The risk-free rate of a country has two components. Has the inflation and then the real part. And you'll have the inflation of the foreign country embedded within that interest rate, and the inflation of Canada embedded in the interest rate of Canada. Here's another example. Well, not an example, but just a sidebar to make you understand that. If I have, say, an exchange rate of a risk-free rate in Canada of 5%, and inflation goes up by 1%, what's going to happen to the risk-free rate? This is easy. Plus, somebody help me out here. You guys know how to add by 1, I hope by now. Okay. If you have a Canadian rate is 5%, but it's comprised of, say, 3% of inflation and 2% real rate. So R, big R is 5, small r is 2, and h is 3. What happens if the inflation goes up to 4%? You should still have the real rate. Now, it's not perfectly elastic, but what happens is when the inflation in a country goes up, so does every interest rate in that country. Right? The risk-free rate goes up, and therefore all the other rates, which are just linked as a spread above the risk-free rate, they all go up too. And that's what they're afraid in the U.S. right now with the quantitative easing, is that they expect, whenever countries have printed insane amount of money, like, there's been, currency crisis in Argentina and places like, I think, Zimbabwe has another one, and those kinds of places. What happens, the inflation goes out of control. If the government's like, well, instead of taxing people, I'm just going to print money and pay my bills with that. Well, what happens once you have $1 billion, dollar bill? Well, that's what you need to buy, some bread or some milk. Whenever a country, a government, or a central bank prints a ton of that currency, it creates inflation. So that's what they're afraid of with quantitative easing in the States, is that when that printing stops, and in the future, when the economy kicks back up, you're going to have that stupid amount of inflation, and then what's going to happen is, because the inflation is very high, then the interest rates are also going to be very high, and the higher the interest rates are, that acts as a brake on an economy. And so that's why people are so afraid of QE in the future, because of that printing is going to cause inflation and cause the interest rates in the U.S. to go crazy high. The last time interest rates were really high, they were around like 18 to 20% around the 1980s, because there was inflation created by the oil shock of the 70s, and that created a stupid amount of inflation, and that's how the interest rate ended up going at such a high number. All that to say that it doesn't matter whether you talk about the inflation rates or the interest rates here, because one is included in the other. The inflation is a component of the risk-free rate. Now, this is the exact equation. You can rewrite that fraction the other way. It's just that whenever you have if you write 1 plus a number divided by 1 plus another number, it's about equal to that. At least when these numbers are small, like close to the origin. So that's why you have the approximate interest rate parity equation, which is just the exact one, but I don't think it's that simplified, but they show you both of them in the book. And I'm guessing you might see both of them in your future courses. So when it comes to an interest rate parity type of question, the key thing is you got to figure out, is the question asking for the approximate equation or for the exact? Here, there's one, out of that entire paragraph, there's one keyword. Approximately, what rate can you earn? So we're going to use the interest rate parity, which is approximate. Oh, this is an example of what I would call an intermediate type of questions. This is just practice, I guess, for future courses. Just get used to you having a little more skills with manipulating equations. So you have the rate in Hong Kong dollar and the rate in Canadian dollars. But instead of just being given these things and plugging in the numbers and getting the answer, right now we know the forward rate, we know the spot rate, we know the foreign interest rate, and we want to know what is our CAD. So we just rewrite the equation as you bring RCAD to this side, and you bring this over there. And now you have what you're looking for in terms of what you know. And now you can plug in the numbers. So the next one now is, it doesn't say anything about approximate, so we're going to have to use the exact version of the equation. So if I did this, I'll show you the, I don't know, I don't have that much time. If you did this, this problem using the approximate equation, you would get to 4.25. But I'm going to show you how to use the exact, because that's what... All you got to do is look for the word approximate in the question. That's how you can tell which equation you should use. So in this case, F1 divided by S0 is 1 plus RGP, GBP by RCAD. So what I want to do is pull out RGBP. So I'll bring that over here. And then I'm just going to take, instead of writing it as a separate line, I just take that one here, and that becomes a -1 over there. And now I can plug in the numbers. So what this says is if the British interest rate wasn't 4.3%, say it was 4%, then probably what I would end up with is a covered interest arbitrage starting in British pounds and round tripping through Canada and back to British pounds. If it was above that rate, then it would be going the other way. In other words, whenever I did that big square cycle, whenever one of the four numbers is not right, then what it does is it creates that imbalance, and then you can just do that until, by doing those very arbitrage trades, it brings those four numbers back into, locks them back into equilibrium. And trust me, like I said before, with triangle arbitrage, same thing with this. Banks are looking at this. They got millions of dollars worth of computers, and if something like that happens for 1/100th of a second, boom, they're on it. And they make a whole bunch of trades. So these are arguments for why those prices have those equations between them. Because anytime the numbers go, the equation is not true anymore, you can make not easy money, infinitely easy money, money with absolutely no risk, and so people are just going to do it, and that's going to bring it back into equilibrium. So now I'm going to slowly bring everything together that I've talked about today. and it's the idea of unbiased forward rate. And what that says is the forward rate, so F1, should be the same as so the forward rate that you can lock in today should be the same as the expected value of what the spot rate would be in the future. Otherwise, the person that's on the other side of that trade is losing their shirt. Right? If they're exchanging to you money at a certain rate, but it turns out to be very different a year from now, when they do have to execute the transaction, they're going to lose their shirt. So, on average, the forward rate is going to be the same as what we expect the spot rate to be in the future. So if the forward rate is too high, then what you do is you just trade, you exchange yen for dollars, you would go into the future market. So here's what, there's kind of a complicated sentence, but here's the easiest way to explain it. There are two prices which should be the same. If one of them is lower than the other, then people that do need to move currency back and forth, they're going to go to the cheapest one. Like if I got somebody on the street corner selling, gold for 100, and the guy across the street selling it for 90, obviously everybody's going to go and buy it from the 90 guy until he runs out of stock. And so that same argument means that whenever one of these two is not the same as the other, then people will prefer the cheapest one, and it will rebalance the two so they're about the same. You can't arbitrage this because you can't. This is an expected value. This is not something where you can lock in that spot rate. But if people think that the forward rate is much higher than what the spot rate's going to be 1 year from now, they're just going to say, well, instead of entering into the forward trade, I'm just going to take the risk because I expect the currency to be lower. So instead of locking in my forward rate today, I'm just going to wait 1 year. I'm going to pick to wait for the spot rate a year from now, then I'll use that one. So it's not something that, there's not an arbitrage argument to be made there for those two are equal, but more that whichever the one that's cheapest, the market in general will gravitate towards that, and so bring it back into balance. So if you put everything we've done today, which is the relative purchasing power parity, the interest rate parity, and the unbiased forward rate, then what you end up with is what's called uncovered interest parity. And it's an expression for the future spot rate in terms of the current spot rate and the spread between the interest rate in those two countries. Now, I think they go through the details of how you mish and mash those equations together to get to the end, but that's not going to be something on the exam. All you got to understand is how to apply this. So here's the question. You're expecting a payment of 500 PLN. It's called Poland. The N, I'm not sure what it stands for, but the Polish money is called the zlota. Don't ask me how I know this. I think it's because before when I was teaching that course, I was looking it up what the Polish thing was. But anyway, I don't know where the N comes from. Maybe it's the Z sideways or something like that. I don't know. So you're expecting a $500,000 Polish zlota payment 3 years from now. The risk-free rate in Canada is 4%, and it's 2% in Poland, meaning that the money in Canada is losing its purchasing power faster. So the Canadian dollar is at a forward discount to the Polish zlota, and the Polish zlota is at a forward premium in Canadian dollar. So right now you can buy 380 PLNs for 100. So that gives you the the spot rate. So since we are now, there's something here that they're trying to confuse you by giving you both the inflation rate and the risk-free rate. The reason why, so when you apply what the forward premium or discount should be, so the spot rate is what, 3.8 right now? Yeah. So when you want to know how do I move forward that rate, you would use the risk-free rate instead of the inflation rate, because you can do the covered interest arbitrage with interest rates, but you can't do it with inflation. Well, you can't trade the inflation rate, at least not easily, not directly. You have these proxy things where you have a bond that pays a rate, a certain interest rate. You have a same bond from the same country that pays an interest rate plus inflation. So the difference between the two bonds is kind of what the market perceives the inflation to be. But the key point here is that the inflation rate is not directly tradable in a market, whereas the interest rates are. You can borrow and lend money at what the current posted rate is, but there's not really financial transactions that you can do using the inflation rate. So when you're given those two, the relationship is stronger with the interest rates than it is with the inflation rate. So that's the one that you would use. Because if you look at this equation here, and uncovered interest parity, and then you look at relative purchasing power parity, you're going to say it's pretty much the same, right? The only difference is that you have the inflation instead of the interest rates there. But this equation holds stronger because you have that arbitrage that happens in the market, and so that equilibrium is going to be a lot tighter than the equilibrium between inflation rates. All this to summarize, when in doubt, use the interest rate instead of the inflation rate, because you can arbitrage those. So the expected current spot rate is 380 PLN for 100 CAD. And the spread is -2%. Now I'm using lots of extra decimals there so that I end up with the exact same answer that they give in the book. But if you only use, say, usually in finance you just want 4. So just set your calculator for 4 and just leave it there. The only exception is when you do period interest rates in 2504, and so it's such a small number that you need to take a couple more. But in general, I could have used just 4 of them. The reason why I had to use extra is so that I would get to the exact same answer. But when you write an exam, I'm not going to be difficult. Usually I don't take off any marks if you give me at least 4. But if you give only 1 or 2, then sometimes you end up at the final answer and you're off by 5,000, 10,000. And then I have to go into your answer, try to figure out part marks and untangle the spaghetti, and I can't figure things out. And so whenever you're more clear and you use at least 4 decimals, you're safe. And so now I can just convert my future payment . So the last concept for tonight is the international Fisher effect. Now, most of you don't remember this from Chapter 7 of 2504. Well, remember the Fisher effect. That's the domestic one. Was the nominal rate was the real rate times the inflation rate. But it's a multiplicative relationship, not an additive relationship. But if you write this out, it's 1 plus R plus H plus RH. But this is very small. And so this is approximately equal to 1 plus R plus H. And if you simplify that, you have the approximate Fisher effect that says the nominal rate is the real rate plus the inflation. Now, there's a similar concept in international markets, and it's called the international Fisher effect. And what it says is this, that another way to write this out is this. The nominal rate minus the inflation, that's the real rate in Canadian dollars. And the nominal rate in the foreign country minus the inflation in the foreign country, that's the real rate in the foreign currency. So goes down to that point here. The international Fisher effects tells us that the real rate of return must be the same across country. This is the way that you can write it out. Right? Small r CAD is the same as small r in the foreign country. What happens is if it's not, this is not an arbitrage thing, but it's called the carry trade, and it was very popular with the Japanese yen and U.S. investments for a very long time, because the Bank of Japan was artificially keeping the interest rates very low, because the problems that we've been experiencing in North America with low inflation or almost deflation and barely any growth, Japan's been going through this for almost 15, 20 years. Like the same thing that started for us in about 2007, Japan has been in it since the early 90s. And they're still not out of it. So in the past, what they were doing is they were doing these unconventional measures, and they were distorting the market, because anytime a government intervenes and sticks their greasy paw into the market, they just gum up the gears, and you have these unintended effects. It's not quite unintended, but what was happening is they created an imbalance where the interest rates in Japan were so low that what people would do is they would borrow money in Japan and invest it into another country at a higher rate. Because the real rate of return, I'm going to spare you the course on economics, but it's related to the GDP in the country, the amount of growth, the amount of economic activity that's happening. So right now, think of our interest rates are at about, the risk-free rate is at about 2%. The inflation's at about 2%. The economy doesn't have any real return. Why? Because there's not really any growth. Like the GDP is flat or just barely growing in population. So whenever you have that the real rate of return is different in the country than another country, what it does is it creates it's the carry trade. It's not called the carry arbitrage because you don't lock it in the same way you do with these other things. But anytime that you can invest and get a higher real return in one country than the other, what happens is people will borrow in the one country that's weaker and invest in the country that's stronger. That sometimes has unintended consequences. The reality, that's why right now Brazil is suffering from a currency that's overheating, that's going up too high. Same problem with Switzerland, right? Because people think they get a good investment in that country, but they can borrow money in the U.S. for nothing or almost nothing. So what they do is they borrow money in the country with very low interest rate, being Japan or U.S., and they invest it in countries where they expect a high real return. Brazil, China, some of the, Switzerland, some of these other ones. So that argument, the international Fisher effect, says that the real rate of return between the two countries should be equal. Because when it's not, then you get these imbalances. An example is the carry trade. Now, this is the last example for today. And it's very simple. Now, DEM, that currency doesn't exist anymore, but it was called the Deutschmark. So Germany is Deutsch, and then M for Mark. And so DEM was one of the biggest currency. And in fact, when you look at, if you do some financial analysis of historical trends, you can tell that the euro is more than half the German mark. Because the euro is a weighted average of all the currency, all the economic conditions of everybody in the European Union, and Germany is by far the largest share of GDP in Europe. So the euro is mostly the German mark. So we want to know what's the HCAD, so you just rewrite the equation. So this was just a simple intermediate level. So that's it. Let's see how much time I got left. 8:43. Yeah, just 5 minutes now. I don't think I'll have enough time to do these examples, but those are great examples. Maybe I'll do them if I got more time next week. Or, well, you only need to study for 17 right now. But when you study for the final exam, these are pretty good examples to go through, to try out. All right, I'll see you next Tuesday. And remember, next Tuesday is last quiz 4 at the beginning of class. Chapter 17.